Miami's apartment occupancy rate is among the strongest across the U.S., but rent growth isn't all that great. What's going on with these two contradictory metrics of market health? We'll explore on today's edition of Apartment Market Dynamics from MPF Research. I'm Greg Willett.
And I'm Cameron McIntosh.
Cameron, let's start with the good news. Give us the rundown on Miami's occupancy performance.
For the past couple of quarters, Miami's apartment occupancy has topped 98%, specifically coming in at 98.2% in the latest measure. That's a significant premium over the national norm of 96.5%. Furthermore, it's the strongest level posted in Metro Miami over the past decade. Occupancy climbed 120 basis points during the past year. That improvement reflects demand for 6,537 units versus completions totaling 3,650 units.
Tight occupancy and substantial demand usually point to robust rent growth. In Miami, however, pricing power is fairly mediocre. Rents did climb during the past year, but an increase of 3.4% for new resident leases feels lackluster relative to that occupancy performance.
If you dig deeper into those rent growth results, the Metro's trouble spots jump out at you. Class A rent growth over the past year came in at 2.6% for the Metro as a whole. Going to the neighborhood level, the key downtown Miami South Beach submarket registered rent growth for just 0.3% in Class A units. Really no movement at all.
You can see where this is going, right? The key word here is condos. While exact numbers on what's happening in the condo market vary by source, it looks like somewhere around 5,000 to 6,000 units have been delivered in Metro Miami so far in this cycle, and another 12,000 or so units are under construction. The primary hotspot for those condo additions is the downtown Miami South Beach submarket, where there's no apartment rent growth at all.
Focusing specifically on the apartment sector, there are 11,077 units now under construction in Metro Miami. While about a third of that future new supply is being built in the downtown South Beach submarket, activity is reasonably well spread out across a variety of locations. That distribution of product on the way looks like a plus for potential demand. Thus, we don't think occupancy is going to take too much of a hit. Our baseline expectation is that occupancy holds at above 97%.
Forecasting rent growth gets a bit tougher. Our base case scenario calls for the market to keep doing roughly what it's doing right now. That's prices trending upward at an annual clip between 3 and 4%, but there's certainly some downside risk to that expectation. Condos about to be delivered could end up in the rental pool in numbers beyond what's anticipated right now, and if that happens, rent change in the Class A apartment sector could slow to nothing overall. There's clearly the possibility that pricing will go negative in the urban core and on South Beach.
Our forecasts for both Fort Lauderdale and West Palm Beach are somewhat stronger than the expectations for Miami. Furthermore, downside risk is more modest in those two other metros in the South Florida region, since their condo construction volumes are smaller. That wraps up our look at Metro Miami. I'm Cameron McIntosh. He is Greg Willett. Thanks for watching Apartment Market Dynamics from MPF Research.
Want more? Go deeper with MPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, MPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.